So, back in 1983, Warren Buffett sat down and wrote this letter to his shareholders. But it wasn't just any letter. It turned out to be a total masterclass in how to think about business and investing. And what's wild is just how relevant these lessons still are, maybe even more so today. So, let's dive in and really unpack the wisdom of a master.
All right, to really get inside Buffett's head, you have to start with the one person who actually genuinely intimidated him. He wrote this quote a year after the letter we're looking at, and it's just an unbelievable thing for him to say. A guy who competes against the entire global economy every single day. So, who in the world was Mrs. B?
This question right here is the key that unlocks that entire 1983 letter. Because the story behind that quote, it's not just a funny anecdote. It's a living, breathing example of every single principle Buffett believes in. Well, that business was the Nebraska Furniture Mart, and it was run by an absolute legend named Rose Blumkin, or as everyone called her, Mrs. B. Her story is basically the perfect real-world case study for Buffett's entire philosophy. $500. That's it. That's all she had. In 1937, Mrs. B, who was a Russian immigrant and couldn't even speak English, took this tiny pile of cash and just built an empire. Think about that. No venture capital, no fancy degree, no prime real estate, just pure, raw grit. I mean, just look at this timeline. It's just unbelievable determination. At one point, when things got tough, she didn't file for bankruptcy. No, she sold her own furniture from her house to pay her bills on time. When bigger competitors tried to sue her out of business, she fought them in court and won every single time. And the story goes, she even sold the judge $1,400 worth of carpet on her way out of the courtroom. By 1983, her one store was pulling in over $100 million a year. So what was her secret sauce? It was so simple, it's almost deceptive. 1, buy brilliantly. 2, run the business with incredibly low costs. And 3, pass all those savings directly to your customers. That's it. But that simple formula created a competitive advantage, a moat, so powerful that even Warren Buffett knew he couldn't compete with it. And you see, the story of Mrs. B wasn't just some fun anecdote Buffett threw in there. It was the setup. It was the real-world proof of everything he was about to lay out. He was showing his shareholders, this is what a truly great business looks like, right before explaining his own playbook. Okay, so this brings us to Buffett's first big idea. And honestly, it was pretty radical. He says his attitude is one of partnership. He doesn't see shareholders as just numbers on a screen or people trading stocks. He sees them as his partners. He and Charlie Munger are the managing partners, and you, the shareholder, are a fellow owner. And he sums it up with this great phrase, we eat our own cooking. This isn't just talk. The directors at Berkshire have the vast majority of their own family's money invested right there in the company, side by side with everyone else. Their fate is completely tied to the company's performance. It's the ultimate skin in the game, and it guarantees they're thinking like owners, because they are. Now, this next point is absolutely crucial, especially today when everyone is obsessed with growth. Buffett's goal is different. He couldn't care less about just building a bigger empire. His entire focus is on increasing the intrinsic value of each individual share. It's not about being the biggest. It's about making each partner's slice of the pie more and more valuable over time. And principle 3 is really just a simple, powerful promise. He's saying, we're not going to waste your money chasing dumb acquisitions just to get bigger. He's promising to treat the company's money, your money, with the exact same care and discipline he'd use with his very own. It's a profound commitment to his partners. Okay, so if the big goal is all about increasing intrinsic value, you got to ask, right? How do you even measure that? This is where Buffett gives us one of his most powerful mental models, teaching us how to look past the spreadsheets and see what a business is truly worth. All right, first let's talk about book value. This is the one you'll see on any standard balance sheet. It's basically an accounting number. It tells you how much money has been put into a company over the years. It's all about the past. But then there's intrinsic value. And this is where Buffett's genius really kicks in. This isn't an accounting concept, it's an economic one. It's all about looking forward and estimating how much cash you can take out of a business over its entire lifetime. So book value is the past, intrinsic value is the future. In Buffett, being Buffett came up with a perfect analogy to make this super clear. Imagine 2 students. The cost of their college tuition, the book value of their education, is exactly the same. But the intrinsic value, how much they'll earn over their lifetimes, could be totally different, right? One might make a fortune, the other, well, not so much. Buffett says businesses are exactly the same.
You know, it's easy to look like a genius when everything's going up. But what happens when things go wrong? Well, that's where you see what someone's really made of. And in 1983, Buffett's insurance business hit a major snag, and his response was a masterclass in honest leadership.
So check out this number, 121. In the insurance world, this is what's called the combined ratio. All you need to know is that if the number is over 100, you're losing money on the policies you're writing. So at 121, Berkshire's insurance arm was taking a pretty big hit.
And this is what makes Buffett different. He doesn't blame the market, he doesn't blame the economy, he doesn't make excuses. He points the finger right back at himself. He tells his partners flat out that the reason for these bad results were decisions he made years earlier. No corporate jargon, no hiding, just, I messed up and here's why. That is what real ownership looks like. And that really brings us to the final and maybe the most important lesson from this whole letter. The huge difference between being an owner of a business and just being a trader of stocks. For Buffett, this distinction is everything. What a line, right? A hyperactive stock market is the pickpocket of enterprise. Buffett's point is that all this frantic buying and selling, this constant churning, it doesn't help the actual business one bit. All it does is create what he calls frictional costs, commissions, fees, taxes that slowly drain value away from the real investors. And he didn't just feel this way, he did the math. Back in 1983, he calculated that investors were on track to pay about $7.5 billion that year, just in commissions. To put that into perspective, that was about the same as the combined profits of the 4 biggest companies in the US at the time, Exxon, GM, Mobil, and Texaco. Investors were basically giving away all the profits of America's greatest companies just for the privilege of trading stocks back and forth. And this whole philosophy, it's the exact reason Berkshire's stock price is so high and why they've never split it. That high price tag is a filter. It's designed to attract people who want to be long-term partners in a business, not short-term gamblers. It helps build a community of rational owners, which then allows Buffett to make decisions for the next decade, not the next quarter. So here we are 40 years later, and that letter feels more relevant than ever. In a market that's faster and noisier than ever before, it challenges us to step back, ignore the daily chaos, and think like a true partner. It asks us to focus on long-term value, not short-term price moves. So the real question it leaves us with is, in today's world, which one are you choosing to be?